Welcome back, my friends. This is Jason, certified financial planner, host of Fighting Words Financial. Somebody out there, please let me know if my microphone is working. I was having a little bit of trouble with it earlier today. So, about today, market is just closing right now. Last time I looked at it, was still down quite a bit. And we are coming up on the completion of pretty much the most brutal first half of 2022 that we've had, most brutal first half of the market year since we've had in the last 52 years or so. Um, which is definitely brutal, but actually the decline started before that, really kind of back in November of 2021. Let's take a look at that just here for a moment. So the Dow drops as brutal first half of 2022 draws to an end. This is from Barron's. It's behind the paywall. If you are part of my Patreon, this is kind of what your Patreon dues go for. It's to kind of keep me in, high quality news sources here. So there's a couple of things I wanted to point out here when it comes to inflation. The Federal Reserve really doesn't look at CPI inflation so much. They look at something called core PCE inflation, which strips out the cost of food and energy. And they do it in a slightly different way than, than core PCI, right? And that is their preferred gauge. So you have headline PCE inflation, and then you have core PCE inflation, right? So the story here is that core PCE inflation didn't go down at all. And I think some people in the market were expecting it to go down. So it rose a little. So the core PCE inflation, the Federal Reserve's preferred gauge for measuring inflation, and one that excludes energy and food prices, rose 4.7% annual in May, a slight dip from the previous month. So, and this article goes on to point out that it isn't reasonable to expect that actual inflation, points to suddenly plunge. And so this is more about looking and going in the right trend. So a couple of things based on some of the other data that was released, the market reacted relatively negatively to this today. Me having been around the block a couple of times and understanding how long it's going to take for this rise in interest rates to affect inflation. And one thing you have to prepare yourself for is the fact that in order to cool inflation, the Federal Reserve has to cool demand, right? Has to cool demand for consumer products. And the way they have traditionally viewed that is through the lens of unemployment. So they are looking to increase unemployment. So for the third month in a row now, we have 3.6% unemployment, which is full employment in the United States. It's really not going to get more than a few tenths of a point lower than that, because people are always changing jobs. People always take a little time off to decide whether or not they work. And there's always, a small slice of the population that simply takes advantage of the unemployment system, right? So this, to me, is a step in the right direction. It's the first step in the right direction. The first clear sign of the first step in the right direction is that inflation no longer seems to be accelerating, right? We're going to see a little bit of variation month to month, a couple of, tenths of a point in one direction or the other. And at some point later on in the year, we start to see unemployment increase a little bit, a softening of demand, and we see increasing competition to provide goods and services as the employment situation looks a little bit more lax, as supply lines start to clear up a little bit. And capitalism will do what capitalism does. It creates a destructive competition environment, and we're going to see prices get pushed down because people are competing to supply what they have to you. So that is what I think is kind of a good sign, is that, yes, it is up 4.7% annually, but it is a slight dip from the previous month. I think the market maybe expected a little bit greater reaction to that. So look, the thing I really wanted to talk about today was the housing market. So there's a lot of news out there on like your major media channels about the national housing market. And the national housing market is never the best way to gauge your housing market, or not the best way to gauge the economy as a whole, because real estate markets really are quite local, right? But there are some disturbing trends here that make you think that some of the positive data is a little bit skewed because of which homes are being built right now and who's able to afford those homes. And there are some troubling signs for affordable housing in the future. And so I know quite a few property developers Man, those guys work really, really hard, like crazy hours all the time. They've been doing that for the last couple of decades or so. And I know I've talked to a lot of these guys about building affordable housing, and they're telling me that the profits just aren't in it, and a lot of it has to do with regulation. And I don't remember exact numbers from the conversation, so I don't necessarily want you guys to think that this is an actual quote of exact numbers here. But essentially, the difference between building an affordable housing condominium and a luxury condominium, or at least one that's intended for the upper middle class, is hundreds of thousands of dollars, and you don't really get compensated for for taking that additional risk of building affordable housing, or that additional basically it costs you almost the same amount to produce affordable housing as it does luxury housing. The price difference really isn't that great, but the profits are way skewed in terms of luxury housing. So the incentives to do that really aren't there, and that's really reflected in the market now when we have. I'm going to show you guys what we're going through here. So let's share my screen here. We're going to talk about Moody's here. This is more of a national consensus. Moody's concludes that the incredible home price boom is over at this point. So reports released this week by several respected market observers point to less good and increased bad and ugly ahead for the housing market. Now, these signals are definitely mixed, in my opinion. For some of the good, the U.S. Census Bureau reported last week, spurred by a bout of optimism when it revealed that new home sales jumped by nearly 11% month over month in May on a seasonally adjusted basis after declining 12% in April. I think that's a little bit of price shock when it comes to how much interest rates rose in that time period, and the fact that people just had to adjust the fact we're in a new interest rate regime. And you're going to see that the houses that were sold were people who could probably absorb the additional cost of rising interest rates. Think of it this way: for every $100,000 that a house is right now, the monthly cost of that has risen by about $500 a month due to interest rate increases. So 696,000 units in May. New home sales were around 17% below the peak of 839,000 units in December of last year. And existing home sales declined for the fourth consecutive month. So it's new home sales that are carrying the weight here in terms of this increase, as existing home sales declined for the first month. And new home sales are still 17% below what they were in December of last year. And I think most of that has to do with affordability and the fact that homes are so much more expensive now just because interest rates have risen. I'm talking about the monthly cost of the home, not the price. And that's driven by the interest rate that you're paying on the loan. These figures, along with a sharp recent increase in mortgage rates and other supporting data, lead Moody's to conclude that the U.S. house price boom is over. The firm which rates securitization offerings, and this is very important, how can these banks who make these loans get them off their balance sheet? And this is what banks do. They package up these loans, they end up selling them on the secondary market, getting off of their balance sheet, and then they're no longer assuming the risk of those loans. So they are predicting material declines in both new and existing home transactions in this year compared to 2021. Supporting the ugly outlook for the housing market was the release today, June 29th, of the quarterly CFO study, which said that a survey of more than 300 U.S. financial executives conducted between May 25th and June 10th showed optimism about the broader U.S. economy continuing to decline. Is that optimism? Shows optimism about the broader U.S. economy continue. Oh, okay. An average index score for the current survey was 50.7%, compared with 54.8% in the prior quarter and 60.3% 2 quarters ago. Price pressures have increased, real revenue growth has stalled, and optimism about the overall economy has fallen sharply, said John Graham. So, look, guys, the recession is not the end of the world here, okay? It's the normal end of a credit cycle. We go through recessions all the time. It's just some of you investors haven't been in the market long enough to remember that. Yes, you lose money in the short term. If you have a long-term strategy, stick to your long-term strategy. The whole point of having a long-term strategy is it's going to be one that sort of weathers downturns. So yeah, that's kind of what we're going on here in the national market. And I wanted to take a look at local markets because in a lot of ways, these are a better signal as far as what is going on here. And let's talk about this right here. Arizona's housing market is cooling quickly. This is June 22nd, 2022. Arizona's hot housing market is cooling quickly. In the past 28 days, 11,845 new residential listings were added to the greater Phoenix area. That's a 34% jump in new listings. I think folks out there who are kind of on the fence about selling or trying to get their house on the market now while prices are still really high. Phoenix is a pretty volatile real estate market. It's unlike a couple of other markets where they just don't have limitations on space like Southern California would, or cities with cities with markets with lots of natural barriers around there. So you have the capacity to add inventory at any time. Like people can start new housing developments at any time. You go to many markets in Southern California or many markets like in New York or something like that, there are no more available lots to build on. So you have to buy something that exists, knock it down, redevelop it, that sort of thing. Phoenix is a little bit different in that respect, and the price volatility reflects that. So mortgage interest rates, of course, are rising, and it's pricing some would-be buyers out of the market. And this says we are absolutely in the middle of the shift. And we're seeing a rapid cooling of the market. We're seeing a dramatic increase in the number of listings, the highest percentage in the number of listings since we've seen since the Cromford report that was tracking it way back in 2011. So despite the cooling conditions, at least for right now, the Phoenix area remains a seller's market, but it could be more balanced soon with buyers and sellers entering negotiations on an even playing field. And that's going to be all about inventory. Buyers are going to have more inventory to choose from, and sellers likely won't be selling their home within hours of going on the market. So, and this is something else that's kind of troubling here. If everything keeps going the way the way it is, we should see some sort of balance in August or September. Right now, the shift towards market balance has not caused home prices to drop. The current median price for home sales in the Phoenix area is $475,000. Last month, it was $471,000, and they haven't seen price decreases yet. It's hard to say whether or not they're going to see them. The current average 30-year fixed rate when this article was written was around 6%. I think it was actually 5.98. As of today, it's about 5.68. Just over a year ago, it was close to 3%. So you're basically looking at per $100,000 there. The price of that home is about $500 more expensive. So do the math there, and you're going to see that it's a lot more expensive than it was just a year ago to own a home. So this is sort of the weekly market minute here, and this is going to give you kind of an idea of how mixed the signals are. Existing home sales declined in May as the market adjusts to higher mortgage rates, meaning sales of existing homes fell by 3.4%. Higher prices and rising interest rates have reduced affordability and negatively impacted buyer demand, resulting in sales dropping to their pre-pandemic levels. The national median price of existing homes rose 14.8% over the year to $407,000, surpassing that $400,000 benchmark for the first time. The number of available homes for sale started rising as demand slowed, which is good news for home buyers because there's going to be more competition out there for sellers, of course. Meanwhile, more homes are being discounted from their list prices in May, suggests that further price softening in the month should be anticipated. New home sales increased while inventory rises. Against expectations, sales of new homes in May surged 10.7% to an annualized pace of 696,000. Mortgage applications increased from the previous week despite rising interest rates. Like I said, it probably just took some people a little bit of time to figure out that you can still borrow when interest rates are over 3%. I've said this many times on this show that my first home I purchased and the interest rate was at 9.5%. Now, granted, that home was only $90,000, but still, that's a lot of interest to pay on a loan, on a loan like that. So purchase applications alone rose by 8% from 1 week earlier, likely boosted by the increased share of adjustable rate mortgage applications. Buying an adjustable rate mortgage application in an adjustable rate mortgage in a period where interest rates are going to rise seems to be a bit short-sighted to me, unless these folks are planning on the Fed chickening out when it comes to controlling inflation. With rates surging to their highest level since November of 2008, right? So the share of ARM applications jumped back over 10% as customers look for other financing alternatives to keep the cost of borrowing down. I say this on channels all the time. Like one of my rental properties has an adjustable rate mortgage on it. I ended up buying that like right in the middle of the downturn in 2008, and it's been great. But my choice now, as interest rates start to rise, is to either pay off that home loan or refinance it and at least fix that rate. I'm probably going to end up I'm probably going to end up actually paying that home loan off and then doing something else financially down the road with it, meaning that I'll probably leave the money in the home for a year or two. So rental prices hit another record, but growth appears to be tapering off. So we're going to talk about rental prices hitting a record here. We're going to talk about some of the negative signs here in the market. And why this could be a problem. So the Texas housing market is probably the best example of this. I'm not picking on Texas. This is just the data that I could find, right? So on the one hand, the data for the real estate market looks pretty good. Total Texas housing sales continued to grow, increasing by 3.4%. Sales were concentrated, though, on homes priced over $300,000. The constrained inventory in the lower price cohort pushed the median housing prices to record-breaking levels. Despite rising mortgage rates, housing market demand remains robust, driven largely by demographics. As building material costs and notably for lumber continued to increase, so did housing starts. So here's the issue here. What type of houses are being constructed across Texas? And I'm not going to assume that this happening all over the country, but I found several other articles that kind of pointed this out. They just didn't have any good data in here. According to Metro Study data, after hitting a record high in the last quarter, the supply side contracted to the earliest stage of construction cycle in numbers of new vacant developed lots. Despite a 26.3% elevation in San Antonio's lot development, the depressed activity in DFW, which is Dallas-Fort Worth, and Houston outweighed the gain. The contraction was most notable in lots priced between $200,000 and $299,000 for both metro. DFW accounted for the most quarterly losses and reduced investment all across all price cohorts, except in lots priced over $500,000. I think developers across the country are facing some of the same quandary right now. Your highest profit developments are in those higher price cohorts, which means that's what you're concentrating on right now. And you would think they might always be concentrating on that, but that's not necessarily true. That market is limited to a degree as well. Quarterly growth in single family construction permits remains steadily hiking to 10.4%, quarter over quarter. All metros posted positive seasonally adjusted growth. Houston and DFW were standouts, not only in Texas, but also compared to other metros nationwide. Austin edged out San Antonio in building permits. So lumber prices continue the wave of rises, of all these rises, hiking steeply at 34%. I was looking at starting to build a new boat this summer. It looks like I'm going to delay that until the price of one sheet of marine grade plywood has basically doubled in the last year. So I'm not starting that boat. So among the 36,000 homes that broke ground in Texas, 80% were appraised at over 300,000. Moreover, Dallas had the most growth in housing starts of 500,000 or more, followed by Austin and Houston, 400 to 499,000, and San Antonio at 300 to 399,000. This is an issue when it comes to affordable housing that people that make a median income can actually afford to buy in the state of Texas or any other state, right? And especially here in a place like California, where the median home price I think is $864,000, like back in March, and it may be close. It may be over $900,000 at this point. But yeah, so both Austin and DFW remain below 1 month's inventory at 0.5 and 0.8 months, respectively. Houston and San Antonio trailed slightly. So we have similar stories going on here in markets all across the nation. We're looking at actually, I already pulled this up. We're looking at Florida being a little bit of a standout here, one of the real positive markets, and that really has to do everything with inventory kind of being in the trash, being super, super low. But the last 3 months, we have seen an uptick in inventory as well here. So we're seeing closed sales decline traditionally 15% year over year. Median home sale prices up 21%. Foreclosures are down. Median sale prices up. In this case, short sales are down as well. But we are seeing pressure on prices at this point, and I think that is very interesting. So mixed signals all across the board. Here's the biggest mixed signal that you're going to find is the number of mortgage applications. So beginning in April and May, every time we saw, the Fed come out and talk about raising interest rates, we saw the mortgage applications drop. They are obviously down for the year. We're also seeing that mortgage applications increased early in June, and those are starting to decline as well. So I'm not getting too excited about the real estate market right now. I hope we're in for a soft landing, but that may or may not necessarily be in the cards, and it may or may not even be in the realm of possibilities that the Federal Reserve even cares about. And let's talk about this for just a moment. Inflation is what is their biggest concern. And I've said this over and over that the Federal Reserve is perfectly willing to sacrifice the stock market and any other market as long as it remains stable and doesn't completely collapse in the interest of controlling inflation. An acceptable number for unemployment during the reign of Paul Volcker in 1982, when he jacked interest rates up to 21%, his acceptable level of unemployment was about 10%. There are some economists out there that claim that if we want to quickly tame inflation, that 10% inflation or 10% unemployment is going to be needed. And these are economists that are on the fringe, but there are more of them than I thought there were. These were not people that I heard about, ahead of time, but the data behind the arguments that they're making seems to work out for me. So as I'm looking through this right now, what does this say about the wider economy? It is more mixed signals. I don't know where the real estate market is going. I don't know where the stock market is going any more than you know where the stock market is going, or any other YouTuber or any other person that is out there that is looking at current trends right now. Humans are really bad at trying to predict where the market goes. But so that's what I wanted to cover in terms of the real estate market today. In terms of the data that's out there. If you guys have any questions, go ahead and let me know. This is the first time I've been 21 minutes into a live stream and no one has commented. But I don't seem to have very many viewers today for some reason. I guess my viewers aren't really interested in real estate. Although in terms of overall wealth building, real estate is an incredibly valuable tool to do that for a couple of different ways. Number one, you could be betting, of course, on that capital appreciation. But one of the best ways to help yourselves out in terms of wealth acquisition is to freeze your housing costs, which is one of the big benefits, especially in an inflationary environment, to owning your own real estate, owning your own primary residence. At least your housing costs are fixed. And I've made this point a couple of times before that my mortgage is less than rent for a 2-bedroom apartment here in the San Diego area. And a lot of homeowners across the nation right now are in that same boat. So here's kind of the issue right now with affordable housing. And I'm not using a precise definition for affordable housing. I'm thinking that what could a family that earns median income actually afford? Median income, let's say it's $63,000 a year for the household. What kind of house can they afford? Well, right now, they would struggle to actually qualify for a loan for a house that's $400,000. And we look at the housing starts that are going on right now, it is concentrated in Texas, at least, on houses that are on lots that are going to have a house on them that's going to be more than half a million. In Florida, at least more than $500,000. In Arizona, at least more than $400,000 out there. What does that say for pricing pressures on rent? I'm going to say that there's basically going to be no incentive for folks who are asking for rent to reduce those prices, right? I've kind of made the decision on my rental properties that this year I'm actually not raising rent. I'm not raising rent because all of my renters paid me throughout the entire pandemic when they didn't necessarily have to. And I want to extend that favor for them for a couple of more years before I start to raise rent again. But not everyone's going to be like me. There are plenty of folks out there that don't have the resources to make that choice. Okay. So what does this do for the overall economy? It means that folks are going to be stuck in apartments and rental properties that they don't necessarily want. Folks that are trying to save, or they don't want to be there, and they're trying to save up for a down payment on a home. They're trying to save up money. They're trying to qualify for a loan. The memes that you're seeing on the internet right now, where you can't afford a $1,600 a month mortgage, but you can afford $2,500 a month in rent. I don't see any improvement in that situation based on the type of houses that are being built right now, the focus of housing developers at this point, and that we need to come up with a solution for that. So this is not a political channel, so I don't get into politics. But well, I'm happy to talk about any solutions that folks have here. So, very interestingly, the S&P 500 ends its worst half since 1970. And I just realized something horrifying. 1970 was 52 years ago, which means that I'm old. 1972 doesn't sound that, or 1970 doesn't sound that long ago, but 52 years ago does. So a couple of other headlines here: Royal Caribbean, Carnival, and Netflix are the S&P 500's worst performers for this year. I consistently get questions about cruise lines and investing. Cruise lines have never really been the greatest investment. They've always been dividend cash cows, but they're also companies, their dividends are a lot of times not covered by current operations, and they have a pretty poor coverage ratio. So their dividends have never been stable over the lifetimes of these companies, and these stocks tend to be highly volatile. This is the big news that's coming, and that if you're a investor who has not been in the markets for very long, you're kind of a newer investor, or even someone who's just, the last time we had an earnings recession, it was just so long ago that you don't remember it. So evidence is building that Wall Street is going to have to scale back its forecasts for earnings. This could easily drag stock markets down even further than it has already fallen. I don't necessarily agree with that, but my predictions are no better than this guy's predictions. I think that the bottom is within 10% of 3,600 for the S&P. So fears are mounting that a recession will be the result of decreased earnings here, or at least predictions of decreased earnings, and a weaker economy seems to be in the cards. A weaker economy is the whole point of raising interest rates to tackle inflation. It is about and the old adage in investing, of course, is don't fight the Fed, right? So potential cuts to these earnings forecasts could be more than a blip on the radar. During the average recession, Wall Street's consensus call on aggregate earnings per share over the next 12 months for companies in the S&P 500 has declined by about 15%, meaning that analysts are saying that the earnings per share estimates for PDE ratios for companies, they're reducing those by about 15%. So right now, the street expects aggregate profit for everything on the S&P 500 of $239, which is such a decline. It would bring numbers down to about $206. So and this is an aggregate profit for the companies, right? If the S&P 500 continues to trade at its current multiple of expected earnings, the index would drop by the same percentage to just below 3,200 points. Interesting. So I said 3,600 plus or minus 10%, and they're saying 3,200. That's pretty much in line with what I'm talking about too. Well, unexpectedly, this article is just as gloomy as I am. So, which I'm not all that gloomy on this. To me, this is just a natural end to a credit cycle. Anyway, that is kind of what I wanted to cover today. Surprised that I don't have too many questions on this live stream today. I wonder if anyone out there's only a few people watching. This is one of my least attended live streams that I've had in a very long time. So I won't make the mistake of talking about real estate again, because it seems that my subscribers do not care about real estate. So it is a huge part of our economy, though. And if you aren't paying attention to it, at least through REITs, let me see here. So what kind of companies, George Shota says, what kind of companies do you consider as better defensive stocks in this environment? Big pharma, mining companies, or the defense sector? The defense sector is probably going to be one of the absolute best defensive stocks in this type of environment. You're looking at most of these really large defense companies. The big advantage they have is they know how to win government contracts. Smaller companies, in a lot of cases, that is their real stumbling block, is they're not as well connected, meaning to people who formerly served in the military. They don't have the ability to win these contracts. They're pretty much only winning the contracts that are set aside for them for various reasons. There are a number of different categories of ownership where contracts are set aside for you. But the Lockheed Martin, the Honeywells, the Boeing, those types of companies are going to do very, very well in this type of environment. But based on the data that I covered before about the housing market, REITs are going to be a great investment, and apartment REITs are going to be a great investment in this time period because there's zero pressure to lower rent prices, and right. Housing affordability is decreasing for folks below that $400,000 mark, and housing starts below that $400,000 or $500,000 mark are decreasing as well. All of the new inventory is going to higher end housing. So right now is probably a really good time to start looking around at various apartment REITs. They are not cheap at this point, but I would say they're closer. We actually saw quite a bit of a decline since the middle of the year in real estate investment trusts that are focused on residential real estate. That represents a little bit of an opportunity, but at this point, they're just fairly valued and not necessarily undervalued. So absolutely, big pharma. Even big pharma is always a risk. Look at the price volatility in some of these big pharmaceutical companies. Now, over a long enough time period, they actually look pretty good. But if you're an investor that is a little bit disturbed by massive price volatility, then pharma may not be something that you want to take a look at. Mining is something that I would be very choosy about right now. Very choosy about right now, especially because of the collapse in the demand for copper and the demand for a couple of other metals that are used in manufacturing. So we may see mining companies actually take a hit as the demand for materials starts to decline. So, but yeah, we can talk about this. Is defense sector stocks is something that my audience has not really asked me to talk about very often. But look, Raytheon right now is having a field day for technologies that are being used in the Ukraine conflict. Many of I'm not going to make this into like a war channel or anything like I see some of these other channels doing. But what I want to say is what's going on right now in Ukraine has been a gold mine for data for the defense industry. Many of the systems that we have wanted to see in action for a very long time on the part of the Russians have been put into action in Ukraine. And the amount of data that's being collected, to be honest, kind of makes me jealous. I wish I was there to do some of that data analysis. I wish I was there to actually see how some of these things work. But Raytheon, from what I understand, is one of the big beneficiaries of this. We are not just us, but everyone in the world right now is gathering intelligence on the capabilities of Russian weapon systems. Raytheon looks to be a big beneficiary. They're one of the major contributors to the technology that's used in the Javelin missiles. It looks like Lockheed is also going to be a very big beneficiary of this. I'm going to say that this exposure of Russian capabilities is probably going to spur a new round of innovation in the defense field, meaning that they're going to be going to Congress and saying, hey, these are the new challenges that are laid out. Now we know a lot more about the capabilities of these weapon systems. These are the responses that we want to develop, and government dollars are going to pour into those companies and going to keep them sustained for a number of years. Before someone sends an email to me on the military industrial complex, I'm very aware of its existence. I'm not making any sort of comment on whether or not this is right or wrong. This is simply reality, and this is what's happening right now. And the fact that I said I wanted to be in there to see all of that data doesn't make me a warmonger. I just really like data. So if you guys knew me, like some of my friends do, you know that's exactly what I'm concerned with, which is looking at all the data because I want to figure out how things work. We are discovering a lot of new things in the defense sector right now, and that is going to spur years of new weapon systems development, new cyber capabilities, new defensive capabilities. So yeah, I do think that that the defense sector, look, I'm talking your Honeywells, your Northrop Grummons, your Lockheed Martins, your Boeings, and a host of other really large companies that are out there. And some of those are not necessarily all that obvious. HP is actually a massive government contractor. There are entire sectors of that company where you can't work there unless you have a security clearance. And like I said, some of this is not necessarily all that obvious. So do your due diligence on these stocks. Drone technology, of course, is a really big winner. Surveillance technology in conjunction with drones is a really big winner in this case. So yeah, I also think that what's coming down the pipe here is going to be further regulatory conflict with Chinese companies that are making these types of technologies as well, because they represent a huge data gathering risk for these technologies being used in the United States. If you guys noticed yesterday, I talked a little bit about the SEC or the Federal Trade Commission asking uh, Google and Apple to take the TikTok app off of their respective stores. And that has everything to do with the data that's being collected and how it's being handled and how it's being basically transferred back to China. You can look for more of this to happen in the future. These are real concerns. They're not made up. It's not necessarily political posturing. And you can look for China to do the same. Think about this, a Tesla parked on a military base in sentry mode could be a really amazing source for intelligence, right? And so you can, oh man, I just spilled my coffee all over a bunch of stuff that I wanted to keep. All right, guys, I guess that's a sign for me to cut this one short. I need to go and clean up this giant mess that I made. But thank you very much for attending today. I will be back on Monday with a live stream, and I'll be out with more videos next week too. I know I promised this week, but I got a little distracted watching some of the political drama going on today that I never talk about. But anyway, thank you very much, and I will see you guys next time.